Hey guys, Doug the Retirement Guy here. We have a new series we're starting off with. It's called Monthly Paying Dividend Funds. 45 different funds we're going to be reviewing over the next 30 days.
So this month we have a review of Dynex Capital, DX. Dynex Capital showing a dividend yield of 15.7. We're going to see deeper if this is good for a retirement account or not and see if they really are performing. So Dynex Capital is a mortgage real estate investment trust, a REIT, and it invests in mortgage-backed securities, which are called MBSs. They also do commercial properties in the CMBSs. So basically what they're doing is they're fulfilling mortgages with security backing. So it makes it for a very safe and secure program. The guarantor is the US government. And so you're really going to be protected here. They have $1.3 billion in market capitalization. The portfolio is worth a little over $11 billion. And they have an annual dividend yield of that 15.7. So this is a solid, safe program that we're looking at. First off, to give you a better explanation, what is a REIT? And the advantages of a REIT are they're a real estate investment trust. Simply put, is anyone can become an investor in a real estate property or real estate organization by buying into a REIT. And the neat thing about it is that they do have many different properties across different platforms and different real estate sectors. So if you want to do railroads, you want to do real estate, you want to do commercial property, you want to do warehousing, you can find a REIT to cover almost everything that you're talking about. Now, some of the things I love about REITs, and that is REITs give you a distribution and are required to distribute 90% of its profits to the shareholders through dividend payments. So REITs, you'll find a lot of times are doing monthly payments and they're doing things to live off of because every dollar of rent that's coming in or a mortgage payment, anything like that, goes right back out at 90%. Diversification. You don't have to put all your eggs in one basket. Put money all over the place with a REIT that you're into the commercial properties, residential properties. Lower your risk to what's happening in the marketplaces. And then, of course, the performance. The performance is generating future financial securities. Over the last 25 years, REITs has outperformed the S&P 500 and other corporate bonds. So it's really something that you're looking at to do a long-term investments with. So the holdings that we're looking at with DX, as we said here, is residential mortgage-backed securities and commercial mortgage-backed securities over $11 billion in value. So why DX? Well, first off, of course, the 15.7% dividend is always getting people interested into it. And if that's a solid number, this is what you're going to want. Dividends and the interest, capital gains to get you 15.7% dividend return. We're going to love that if that's a true hardcore number. Now, the other thing is they've offered growth of a dividend of 10.26% over 1 year. We're starting to see now, and we'll show you here shortly, is that they're starting to grow their dividends to get more. They're getting more profits, which means more money back to the shareholders. Now, of course, this is a monthly paying dividend, which is what we love here on the channel. And monthly paying dividends, we like the ones that you can do the regular cash flow, which is get that check in every month and pay your bills and then live. So now when we take a look at the DX 1 year return, you can see that this thing is fairly held up from the highs of the March, and then the drop off in April when we had the tariff issues that came into place. But after that, you're seeing it the rest of April and the beginning of May, you're starting to see this thing pulling completely back out and getting back up to average levels to where most people are expecting it to be, because they find out that this is actually a well-protected, well and safe program to be in and a stock to be in. So when we look at this, the DX 1 month out is 9.13 growth percentage. 6 months is down only 0.72. Year to date, down 1.35. Now you see that is a bigger drop just in the month of that April, where we're up to $14 a share, dropped almost down to a little bit above $11, a $3 drop. So it's really covering itself well. 1 year is 0.89% return, and 5 year is negative 0.48. So I really put this as, if you look at the numbers on the bottom, it's a fairly smooth level period right now, regaining itself. When we look at the dividends, as I've said, you take this, and I put this chart out there for 10 months, or 10 years out, and they were paying a better dividend, and now they've come down to, in 2019, they reevaluated everything. They reevaluated their entire company and how they're doing dividends, and you can see they've been very solid for basically 6 years already. Very, very solid. Now, the dividend safety, they get rated at an A+ rating because they're $1.3 billion small cap. For that dividend, they're very strong and very protected of it. The next thing is the 16.41% forward yield. So they're looking at the increases that they're predicting, and what they're expecting from it will put them in the top 15 in the REIT category. Again, that's going to give you an A+ rating when you're starting to look at dividends. Now we take a look at the dividend growth year over year, and this is what everyone's really starting to look at, and what we got excited about when we look deeper into this. Again, once they reevaluated what they did in 2019, which is the COVID and the pandemic period, they've come out of that and they've had a flat rate while they're I'll call it reorganizing and regrouping their company, getting it to be very profitable. And now you're starting to see recently a 30% growth in their dividends. So we're seeing some big step ups on a fairly regular basis. And that's why we're seeing this as an A+ rated dividend stock. So we take a look at this over time. We invested $10,000 into DX back in May of 2024. Stock at that time was $12.32. We were able to buy 811 shares. When we go out a year farther out, you can see 0.89 hit right on the target. Now the dividend paid out 14.12%. And you can see the dividends have gone from 13 cents, 15 cents, now up to 17 cents, and continuously growing. So we ultimately came back with a 15.01% return off of the stock value. So again, if we're sitting here using this for living off of dividends, 14% is a very healthy number, getting $1,400 off of only $10,000. You're not losing any net value in the product, so you're actually a step ahead. So now what we did was we took our chart and put it into a line bar and took each and every month, and you'll see that really DX is a smooth operating program. Their average price is $12.49. Their current cost is $12.43. So it's about 0.5% below average. So there's a little bit of gain to be had just getting back to average, which is what we show you in the last screen, is that this is coming back to its average point. Now we're looking for growth. Now, all the professionals, everything I read on this, the return potential, the 20% dividend, which is the compounded annual growth rate, which it measures the investment's annual growth rate over time, is in the top 20%. So the company may not be getting a huge increase in the price of the stock, but they're expecting to get regular returns and increases in the dividends. Again, another A+ rating for it. Now, here's what we have looked at so far. We do this with about 10 to 12 different analysts, and we pull everything together. Currently, right now, their average point, as I've told you, is $12.50. They've come back and given us a minimal gain of $13.50 and a high of $14.25 over the next 12 months. So basically what they're trying to tell us, that we read it as, over the next 12 months, that if everything goes right as planned, they will get back to their highs right around that $14.25. A conservative person is going to come back and tell you that's going to be $13.50 from its average of $12.50 right now. So when you take a look at the average price at $12.49, that's the average that they're at now, and you take it to the high point of $14.25, you're looking at a 12.77 potential gain in the stock value. So even though we think that this is going to be a stock that's going to be slow growing, 12% over 12 months, that's basically about 1% a month, you're going to have a nice growth plus a very, very strong dividend. That's why everyone that I've talked to so far comes back and says, this is a buy as we see it today. So for DX, we do put it as a moderate buy. And for a retirement account, we tell you this is a moderate buy because this will work in a retirement fund. The reason for it is the NAV return rate, which is your stock value return. Even though it's 0.89, we have the experts and we have analysts looking at this saying there's a potential of a 12% gain. Your dividend of 14% is very good and is very solid, and everything of this program is backed by the government. So overall, we're looking at this, home mortgages, the only thing that's going to happen with home mortgages is interest rates are going to go down. When they go down, sales of mortgages are going to go up, and that's what they're predicting their growth on as the market changes. So right now, this is where I believe it's time to buy into this and prepare yourself for A, strong dividends and a potential of some very strong growth. Guys, this is Doug, the Retirement Guy. If you like what we're doing, give us that thumbs up. Like I said, we got over 45 different videos coming out just on monthly paying dividend stocks. You don't want to miss any of them. Just hit that subscribe button. And also, if you like what we're doing, leave a comment down below. Everything helps the channel grow, and we're hoping we can grow your financial wealth and grow your retirement future. We'll see you next time.